China's Central Financial Work Conference just ended. The anti-espionage agency, the Ministry of State Security in China, immediately targeted the A-shares market and sternly warned the four major shorters in the stock market, including those who hold shorting views, speak shorting voices, and conduct shorting activities. It unprecedentedly elevated the security of the stock market to the height of national security. The official WeChat public account of the Ministry of State Security published a post on November 2nd titled, "State Security Agency serves as a firm guardian of financial security." The article was widely shared by major Chinese media outlets. Some ill-intentioned people are trying to make waves and take advantage of the chaos to make profits, and there are not only those who hold shorting views and speak shorting voices, but also those who conduct shorting activities. They attempt to shake the confidence of the international community to invest in China, intending to trigger financial turmoil in the country. All these have brought new challenges to the maintenance of financial security under the new situation. Behind this stern announcement, it can be seen that China's stock market, finance, and economy have reached critical junctures, so much so that it has had to send in state security to safeguard them. State security was originally meant to deal with foreign countries. Chinese shareholders have the most to say in how the Chinese stock market is doing. Shareholders have called themselves Leeks. That is, ordinary retail investors are like leeks growing in the ground, forever at a disadvantage. What characterizes leeks is that they grow back after being cut. Even major mainstream media in China have openly summarized the iron law of the Chinese stock market. Namely, 70% loss, 20% even, only 10% makes money. This is the scene during Halloween in Shanghai. Look, this person dressed up as an A-share stock market with falling stock indices and leeks in his hands. The implication is that China's stock market is a place to cut leaks. Let's listen to the opening part of a song about leaks in the stock market that is widely circulated in China. This is what the slogan of the song is. You must hear it if you plan to speculate in the stock market.
道琼斯向东26000里呀，满3千5百3000点婴儿底，只为那有一条发财河啊，河水流过韭菜营啊。
We will play the song at the end. The audience can tell if the song has summed up the situation well. So, who are those that hold shorting views, speak shorting voices, and conduct shorting activities of China's A-shares stock market? Let's analyze them one by one. First, there are international short sellers who can be called foreign leaks. In the past 2 years, there has been a succession of international players and the world's mainstream funds announcing their withdrawal from the Chinese market. According to the balance of payments data released by Chinese officials recently, China's direct investment liabilities, which is a measure of the country's FDI, dropped by US $11.8 billion between July and September this year. This is the first decrease since the State Administration of Foreign Exchange began compiling the data in 1998. It is also the first time in 25 years that there has been a net outflow of foreign direct investment, FDI, in China. It means that the amount of foreign investment in the mainland is lower than the amount of investment that flows out of the mainland, underscoring the challenges that China faces in attracting foreign investment as Western countries take steps to de-risk. These renowned Western leaks originally wanted to share the so-called dividends of the opening up and reform in China. Instead, they got slaughtered. Unable to tolerate the long-term losses of the A-share market, they had to escape China. The first one is BlackRock. It's known as the world's most powerful asset management company. It started investing in the A-share market in 2019, but in 3 years it has suffered a 30% loss, equivalent to a loss of nearly $260 billion. The person in charge of the China region had to quit. It announced that it would shut down its China-themed fund on November 7, 2023. Deutsche Bank is the world's largest fund management company. Its assets under management were 8.59 trillion in 2022, equivalent to half of China's GDP. Every investment decision made by Deutsche Bank causes a sensation and attracts attention in the global financial markets. However, even such a financial giant with the world's top investment experts and analysts can't figure out what's going on in China's stock market. It can't afford to continue its game in China anymore. Foreign capital BlackRock fled from the A-share market. Why? Why did it leave? It never suffered this kind of loss before. It's losing money here like crazy, you see? It said, after considering the interests of investors and shareholders, BlackRock made the decision to liquidate the fund due to its relatively small size. Let me translate it for you. It means that although the China-themed fund lost a lot of money, fortunately it was a small fund and didn't have too bad an impact. So they simply stopped the losses to avoid getting punched in the face. What kind of company is BlackRock? It's the world's largest asset management company with 9 trillion in assets under management. How big is that? It's bigger than Goldman Sachs and JP Morgan, who we all know. And there's been a lot of talk about BlackRock buying a Ukrainian state-owned company for $0, right? It's that BlackRock, okay? But it has fallen hard on its face in China's A-share market. It has been slapped hard on its face. Should we laugh at it? No, we need to reflect on whether it's BlackRock that isn't suitable for the Chinese market, or if it's just hard to make money in China's A-share market. The comments from netizens underneath the video show that they are well aware. They wrote, China's A-share market is the hardest market in the world to make money. It's the only one and no others. Had Warren Buffett been born in China 20 or 30 years ago, he would still be a delivery man. A delivery man is pretty much the only option Chinese people see after losing their jobs, referring to people who have lost everything. In addition, the world's second-largest sovereign wealth fund, Norges Bank Investment Management, has closed the Shanghai office of its China operation. The world's largest public fund company and the second-largest fund manager in the world, Vanguard Sovereign Fund, plans to exit the China market. Moreover, Gallup, the US-based polling and consulting group, is exiting China. CDPQ, Canada's second-largest pension fund, is closing its China office, and Citibank has announced its decision to leave the Chinese market. According to the China Securities Investment Funds Association, CSIFA, 2,344 private equity funds have been cancelled in China so far in September 2023, causing the Chinese media to exclaim that the market downturn is compounded by the extinction of the shell business. Shell business refers to a non-listed company acquiring a listed status by purchasing a certain percentage of equity in an already listed company through the securities market, and then injecting its own relevant business and assets by way of reverse takeover for the purpose of indirect listing. Following the introduction of the anti-espionage law by the CCP, foreign investors have made a record sell-off of mainland Chinese stocks, resulting in a cutoff of financial foreign investment. At the same time, foreign investors and multinational corporations are accelerating their withdrawal from Hong Kong's stock market. Second, who are the short sellers in the Chinese stock market? Simply put, there are 3 categories. A. Listed companies that lend restricted shares through refinancing. B. Large institutional investors, funds, and private equity quantitative transactions. C. Domestic and foreign-funded institutions that use asymmetric information to deliberately short sell. Third, who are the ones who speak shorting voices of the Chinese stock market? We concluded that there are the following ones, but it's more than just these ones. 1. The Wall Street Journal published an article with a rather pessimistic description of the Chinese stock market. For example, on August 3, 2023, it printed a report titled, China's Retail Investor Confidence Collapsed. The A stock market is difficult to recover. It reads, China's 200 million strong army of retail investors have withdrawn from the stock market and started to increasingly put their money into money market funds and insurance products. or simply deposited in the bank accounts, which has had a huge impact on the A-share market. According to official estimates, retail trading accounted for about 60% of total trading in China's stock market last year. 2. Morgan Stanley has continuously downgraded China's A-share market and has publicly urged investors to stay away from it, considering it to be full of fraud. 3. Goldman Sachs issued a negative report on China's state-owned banks, and Moody's downgraded the prospects for China's real estate sector to negative. 4. Reuters published an article, "Part of China's economic miracle was a mirage," pointing out that China's economic growth is a false, superficial boom. 5. U.S. President Joe Biden described China's economy as a ticking time bomb and said that China's finances could collapse, banning U.S. capital from flowing into the Chinese market. 4th, who are the ones who are hollowing out the Chinese market? China is experiencing the largest wave of capital flight in years. Some analysts claim that in the Chinese stock market, more than 80% of the listed companies are listed to raise money and cash out, and then secretly transfer the money overseas. The Chinese media reported that in 2022, the A-share market lost 1.9 trillion yuan, or about $26 billion due to corporate capital raising and shareholders' shareholding reductions. For example, a company called Hongxing Technology with a net profit of 562 million RMB paid a dividend of 481 million RMB before going public. It was 88% owned by a family. The Chinese media described it this way. 77-year-old chairman led his family to rush to the IPO, first divide the money before going public to replenish the blood money. Another example is an agricultural science company called Syngenta. Of the 65 billion yuan raised by this company, 19.5 billion yuan is to be used to repay long-term debts, accounting for 30% of the total amount raised. The scale of raising funds to pay off debts has quickly aroused concern from the outside world. And then there's Pengdu Agriculture, which spent 562 million to acquire a sister company with a book value of negative $22,400. It should be noted that these practices and companies that have been exposed by the Chinese media for hollowing out the A-shares market are relatively small in scale, and their official backgrounds aren't that strong either. The real powerful ones come from the CCP's elite interest group. They collude internally and externally, make deals with money and power, falsify finances, and package the companies for listing. It then exploits the loopholes in the system, reduces its holdings in violation of the law to cash in, and even goes bankrupt and reorganizes itself after hollowing out the original enterprise, and then goes public again to reap money. Then a large amount of the money is secretly transferred overseas to reap the dividends of high interest rates in US dollars, leaving the domestic capital market in a disastrous state. It can be said that a financial and economic crisis has already set in China. Enough signs have surfaced. The reason why it hasn't fully manifested is mainly because the CCP government has used administrative intervention to suppress it. But such suppression can only be temporary, and it's likely to amplify the scope of the financial crisis and intensify its force. In reality, starting in June 2018, ignited by the US-China trade war, a large-scale default wave of peer-to-peer online lending platforms happened, triggering systemic financial risk in China. In July 2021, a default wave of real estate developers led by Evergrande officially lifted the curtain on systemic financial risk. In September 2023, the Federal Reserve raised interest rates continuously, leading to the default of the US dollar-denominated bonds of Chinese real estate enterprises. And the arrest of Xu Jiayin, the boss of Evergrande, is a major sign that China's real estate bubble has completely burst. In addition, the Shanghai stock market recently fell below the 3,000-point policy threshold again, and the three carriages of investment, consumption, and net exports that used to drive China's economic growth are paralyzed. The four markets of real estate, stocks, bonds, and foreign exchange are all in a mess, revealing the extent of China's financial crisis. Furthermore, there are bad bank loans and local debts. 2. Financial nuclear bombs that are bigger than real estate that haven't yet been completely detonated. The above events and occurrences can be viewed in our previous episodes. In order to save the malformed Chinese economy and avoid the crisis, the CCP authorities have adopted a series of proactive fiscal policies and a loose monetary policy. It issued an astronomical amount of local government bonds and enterprise stocks, printed an enormous volume of money, through which it once created an economic miracle, forming the world's second-largest economic powerhouse stacked up with debt. However, finance is the blood of the economy. The large volume of cash failed to flow into the real economy, promote technological innovation and industrial upgrading, and inject new vitality into the economic growth. Nor did it steadily increase the people's income, elevate the population to reasonable consumption so as to achieve the benign cycle of the economy. Instead, the indiscriminate issuance of debt has been piled up and flooded into a large number of ineffective or excessive infrastructure, as well as rotten-tailed residential buildings and other capital-intensive industries. It resulted in the emergence of a massive myocardial infarction or cerebral thrombosis of the economy, so to speak. In 2018, before the outbreak of the pandemic, this chart was circulating on China's web. It showed that the total market value of real estate in China reached 65 trillion, exceeding the combined total of real estate in the US, EU, and Japan, which was 60 trillion. China's real estate bubble should far exceed the US subprime mortgage crisis in 2008. Currently, the size of China's local government interest-bearing debt has reached as high as 110 trillion yuan, or more than US 15 trillion. After relying on land finance over the past few decades and borrowing new money to repay old debts, the CCP now hopes that the capital market will play a vital role, becoming active in order to inject new capital into China's economy. China's 200 million shareholders and 700 million fund holders are inexhaustible leeks that can be picked up and cut by the combined harvester of the party and the government in this red country. So, 20 urgent directives have been issued concerning the stock market in succession, including halving the stamp duty, simplifying the procedures for securities, tightening up on share reductions, tightening up on refinancing, tightening up on IPOs, lowering the interest rate on deposits, lowering the personal income tax, lowering the interest rate on mortgages, and encouraging buybacks, and so on. For the next step, CSI will enrich the index systems based on cash dividends and share buybacks according to the characteristics of share buyback behavior in the A-share market, future development trends, and market investors' demand for buyback index products. The number 20 directive is to raise the issues of war against investors who short China's financial markets via speech or acts and the problem of accelerated capital flight to an unprecedented level that concerns the stability of the regime. The government certainly doesn't want to cause panic among the public, so recently in the media, people from various sectors have been asked to make positive interpretations of the government's recent moves. China is currently the world's second largest economy, and our banking system is also the largest globally. The country boasts the second largest markets in insurance, securities, stocks, bonds, and more. However, the financial strength does not yet match the economic strength. Particularly, the financial scale is large, but its strength is not enough. All kinds of foreign-funded financial institutions crowd into the Chinese market, which is conducive to enriching financial market entities, optimizing financial supply, improving the financing function and resource allocation efficiency of the Chinese market, and promoting a wider range, a wider field, and a deeper level of opening up. However, Chinese stockholders and foreign investors, having been harvested numerous times, are beginning to wake up. Judging from the current public opinion on China's web, even if the government issues another 200 directives, it's unlikely to boost the market confidence. For the CCP, all the tools in its toolbox have been exhausted in terms of dealing with the current Chinese stock market. The only thing that can be done is to prevent insiders from joining forces with overseas financial predators. That's why the Ministry of State Security steps into the picture to prevent an economic coup against Xi's government. Will it work? We will wait and see. Finally, let's listen to the ending of the song Stock Market Leak. The proper name of the song is Luo Cha Stock Market. The state of Luo Cha exists in an ancient Chinese novel. It's an upside-down land where everything is reversed. Ugliness is considered beautiful, and black is confused with white.
资本市场是挺经济，在 A 股根本就没关系，业绩好哪个不分红？垃圾涨停没道理，几点的美股有股神，看看 A 股不敢买，他眼说暂时那政策是，到底那 A 股是熊还是熊市？那蛮牛，那兄弟亏，那个兄弟赔，那熊市坑，那个坑买谁？那扭转熊掌。是我们 A 股根本的问